The three things that it takes to get into the investing business are deal flow, judgment, and capital. Capital is the hard one. Either you made some money before or other people trust you enough to give you capital. Many of the top VCs are related to, married to, or come from families that have an enormous amount of capital. Sometimes you look at those people and you scratch your head and you say, how is this person in the venture business? Well, they had a lot of family money, or they married into money, or they were managing money for somebody else, or they were friends with a billionaire, or had access to some large fund. And that access to the capital is what got them in the business. If you join Spearhead, we actually give the Spearhead leads, who are founders who we're training up to be investors. We give them $1 million checkbooks, and then we help them raise more money from limited partners later on. So that is another way to get capital. You can always raise it from friends and family, but this is both the hardest and the easiest depending on who you are. The second is judgment. As they say, good judgment comes from experience, and experience comes from bad judgment. Often it just takes time to build up. Judgment can often be about applying your highest standards and your taste in the things you know the best to other people. Very often, as a founder, you have a very high bar for yourself. You only want to recruit the absolute best. You only want to do your best work. You're constantly into self-improvement. You're always the worst critic of your own business and your own product. Every little thing in your product that's wrong bothers you. But then you meet somebody else and they're raising money and you fall in love with their idea, and you ignore the fact the person doesn't seem that smart, or it's not someone that you'd actually work for or even hire, or their product is only half baked or half finished, or they're executing slowly. You just look past all that. You lower your judgment because you start fantasizing about all the things that could go right. So it's very important when you're investing in other people that you keep a high bar. You have to have taste. Some of the best investors that I know are incredibly difficult people. It's very hard to please them, and they see the problems in everything. In that sense, a good investor can often be a lot more cynical or pessimistic than a good founder. A good founder has to be a rational optimist, whereas a good investor sometimes will bounce maniacally between being optimistic enough to see the future and get into the deal, and being pessimistic enough to see all the downsides and pass on 9 out of the 10 that they look at. If you're doing more than 1 out of every 10 deals that you look at, you're probably being too optimistic. If you keep stumbling into all the great deals all the time, that says more about you than it does about your deal flow. There are always exceptions, of course. If you're sitting in the latest YC batch and you're getting to see everything good that's going on early, or if you're running the Stanford Entrepreneurship Club and you've seen tons of deals go by, and you may have a unique advantage to your network. The last piece, though, the deal flow and the access, that's what we're going to focus on, which is how do you get deal flow? How do you get good access? Deal flow and access are not the same thing. You can get deal flow by going on AngelList. You can get deal flow by going and sitting at Y Combinator Demo Day. You can get deal flow by going to any technology conference bake-off. You can get deal flow by watching Shark Tank. But that doesn't mean you have access into those deals. It doesn't mean that you have the ability to invest in those deals when you want, on the terms that you want.